Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about the worst investment advice or the worst money advice when it comes to beginners and they're just starting out to invest or just trying to figure out finances in general. And so we'll do the regular stuff, go through the portfolio real quick, and then on the back half, we will talk about the worst money advice, quote unquote, for beginner investors, beginner financial saving, anything to do with finances essentially. So it's a different take on the video, but we will definitely do that. So we will get right into it. But before we do get into it, if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And so here is the portfolio. Of course, we always put $100 now every Sunday, now with instant deposits, but we do it on Sundays just so that it doesn't mess up with the percentages as you see. So I always show proof every week that we do put up $100 a week, and that'll be right here. And so the portfolio today closed at $4,443.14, up 6 cents on the day. Really no change in the percentage. It did really well throughout the day here, and then dropped off around 2:35 p.m. just peaked there and just went down from there, and which is totally fine because we are investing long term. So for the 1 week, we are up $24.52, up 0.55%. For the 1 month, we are up $36.97, up 0.84%. For the 3 months, we are up $364.03, up 8.92%. For the 1 year, we are up $648.14, up 17.08%. And that is the same for all. Just a side note, I did get a comment about me saying a lot, so I'm really trying hard in this video not to say for space, for the gap in between, weird silence. So just pay attention to that. So in first position here, we have BCE, which is Bell Canada, ticker symbol BCE, closing out at $57.70. We own 8 shares of this. As you can see, here's the quick shot of that, total position value, so on and so forth. So you can take a look at that. And again, that is BCE. Next position we have here is Bank of Montreal, ticker symbol BMO, closing out at $116.80. This one here is the snapshot of what our average price is, percentage of the portfolio it holds, and our total return since owning the position. So there it is. And that is BMO. BMO is actually the stock that we are buying for the rest of the month of April. I will have to buy this one before Friday just because the ex-dividend date lands on a Friday. And if you haven't seen the video about the ex-dividends, I'm going to put a card right up here somewhere for you to take a look at that, where I talk about how dividends work a little bit. So that is that. So again, BMO, Bank of Montreal. And next position we have here is Bank of Nova Scotia, closing out at $78.27. Ticker symbol for this one is BNS, as you can see. Here is the snapshot of the whole position in the portfolio. Give you a second to look at that. If you can pause if you want to take a look. And again, that is Bank of Nova Scotia. BNS is the ticker. Next position we have here is Loblaws. Ticker symbol L, closing out at $68.73. Here is the snapshot of the position. If you want to pause and take a look. And again, that is Loblaws, ticker symbol L. Next position we have here is Manulife Financial Corporation, ticker symbol MFC, closing out at $26.83. Here's the snapshot of the whole position again. And again, that is for Manulife Financial Corporation, ticker symbol MFC. Next one is Royal Bank of Canada, ticker symbol RY, closing out at $117.11. This is the snapshot of the position. This is the position we updated at the beginning of April, or right up to about last week when we stopped because we had to purchase BMO to be within the ex-dividend date. So here's the snapshot on that one. It is currently holding 19.11%, of the portfolio. So as we increase other positions, this percentage of the portfolio that it holds will decrease, of course. And again, that is Royal Bank of Canada, ticker symbol RY. Next position we have here is TELUS Corporation, ticker symbol T, closing out at $25.59. Here is the snapshot of the position. Currently, we are losing on this position, but we will be fixing that eventually here. And again, that is TELUS Corporation, ticker symbol T. Next position we have here is Toronto Dominion Bank, ticker symbol TD, closing out at $84.59. Here is the snapshot of this one. And again, that is Toronto Dominion Bank, ticker symbol TD. Here is the cash portion, so $153.20, which we will purchase BMO or Bank of Montreal with. So we will go ahead and head back to this one here, just go on the day. Or actually we'll leave it here because this is just a nice, a nice view of the growth over time of consistently investing every week, putting in $100, of course. So what are we going to talk about today? We are going to talk about the worst money advice that I hear a lot of, or investing advice on how to start and so on and so forth. Because it seems like when someone comes out and is like, oh, I got some money, whether it's from extra money from a budget or extra money from an inheritance or anything of the sort, they just happen to have some extra dollars and want to start investing or want to start saving. They're just starting out, they're beginners, and they go on the glory of the internet, and a lot of weird things happen where people come out of the woodworks and they have their own opinions, their beliefs, their biases, and they just really give you service level advice. I'm not giving advice. I'm going to give you my opinion on the advice, but it is not advice whatsoever. Again, I'm not a financial advisor. I'm definitely not your financial advisor. And so if you are seeking financial advice, go seek a professional. So that's what we're going to talk about today. I'm going to give you the goods and the cons of that advice and really give you context around it. And so that's just a brief intro of what we're going to do today. So the number one worst piece of advice that has no context, if you don't explain the context to it, typically it's just surface level content, is the 10% rule. I know I've mentioned this in a few of my videos where 10% is a good rule. I should always put an asterisk beside that. And because it is varying differences in someone who makes $30,000 a year compared to someone who makes $100,000 a year. And that 10% rule can really be a big difference. For someone who, let's say, works a part-time job in school, wants to start investing, and for someone to give them advice on 10%, that 10% could be the amount in their budget that keeps food in their stomach or food on the table. Or for a family that makes, across Canada, the wage differences is different, of course. And to tell someone who makes, let's say, $20,000 a year to put away 10%, that could be their electrical bill. That could be their internet bill, which is essential in these days to stay connected with the world, to work at home, so on and so forth. That could be the difference in having, again, food or clothes on their back or food on the table. Not food on their back, but food on the table. Whereas if someone made $100,000 a year, completely different. They can put 10, 20% away and still live a cush life. And so always with a 10% rule, it's not always 10%. In essence, there's a book called The Richest Man in Babylon, which talks about the 10% rule, but they forget the part where it's a 10% rule if you're over the poverty line. It's a good general rule to be putting 10% away if you're over the point of poverty. Okay, so over the point of poverty makes sense. But if you're bringing in 20K and it just doesn't make sense, please don't take that rule so literal. There has to be context behind it. So that's my first one. It's not a bad rule. It's just one of the most common rules without context that I seem to hear about a lot. Next one is a brand new investor comes in and has, 5, 10K or whatever amount it is, and they want to start getting invested. And then on the other hand, you have someone who is super excited about an investment, whether it's, stocks, mutual funds, Bitcoin, cryptocurrency, whatever it is, real estate, things like that. And they're over excited about it. They're talking, this is the next biggest thing. And it seems like they're just super excited. And so they'll talk about it very freely with everyone. And and why their beliefs are that way and so on and so forth. The one thing that when it comes to that, because there's a lot of, it's like hype, it's like a hype stock, right? Is that for some reason when someone gets hyped about a stock, they kind of throw the fundamentals right out the window, principles right out the window, and they just talk about how this company is gonna blow up, it's gonna 10x, it's gonna 15, 20x. And you see a lot of that now on YouTube, on the pages, and they completely throw fundamentals out the window, or even principles in investing for beginning investors. So the one thing is that every investment or everything that you're excited about, whether it's you or someone else or whoever it is, there's always a story to an investment. And the thing about stories is you can really alter and weave the way that that story benefits one person or one investment. It really goes, it favors one side. And this is where it comes into due diligence. Do your due diligence, work, study the investment, study the financials, because that's most important. Is if a company's not bringing in money, how is that company profitable? Is it just like hype growth like we've seen this past year, where a lot of the times, a lot of these hype stocks that I like to call them are typically not fundamentally strong. Their balance sheets don't make sense. Their financials aren't making sense. They don't turn a profit, or they don't even make a profit. And so please understand that when someone does overhype a stock or is really excited about it, good for them. Whatever asset class it is, real estate, gold, whatever it is, really, really do your research. Typically, you need cold hard facts. You need to pull those from financials. Statistics, like even statistics and numbers can be skewed and favored in one direction. And so just make sure you have cold hard facts, context around the company and what it's doing or whatever it is, of course, and pull information from the financials. Because if you're investing in a company, the top three things that a company should always have is profits, is cash, and assets. Okay, those three things are like the characteristics of any company or any kind of asset class, that when it comes to evaluating or researching those three things, and a lot of the times new investors, they want to jump in and go gung-ho, but the thing with doing that is that they forget to build a foundation of basic concepts, and they don't have systems in place like dollar cost averaging, consistently investing, and those sort of things. So just be very cognizant of that when it comes to when you come across these videos that are so gung-ho about one asset class. So whether it's gold, Bitcoin, whatever it is, silver, real estate, just be very careful, do your research, of course, and really get the cold hard facts. For example, if there's a company that has a really good concept and they're trending in the right direction and they're very similar to a competitor company, and you can see that they're expanding across the world, they're doing those sort of things, then yeah, I mean, that stuff is very good information, but it's still secondary to what the profits of the company are, the cash that they have on hand, their balance sheets and stuff like that, and their assets that the company holds, and that's very important. So really, that's really all that other information is secondary to that kind of stuff. And so just be aware of that. So that's another one that I've noticed, because you see a lot of these hype videos, so I just want to address that way longer than I wanted to talk about that one. The next one is, the saying, just index and be done with it. Which is not bad advice. ETFs, it's not bad advice. I have my own reasons why I don't invest in like specific ETFs. The only ETFs that I invest in are the S&P and the NASDAQ, to split it up just to keep it safe. But I don't go into like selective industries indexes like oil and gas or I don't know, retail, whatever it may be. I don't go into those specific ones because I have my own reasons to pick individual stocks over ETFs. And again, I have a video for that on why I don't buy ETFs except for the S&P and and the NASDAQ, and I'll put a card up here for you on that one if you want to go check that one out. But there's the problem with saying just index and be done with it is that's kind of like a solution where like, here's the solution, now go away. It's not really educating, you know, the new investor or giving them an idea of how the market works. And so it's always good to pay attention to that, because we don't ever, well, for me, I don't ever want to give them a solution and then be done with it and get out of my way and never talk to me again, sort of thing. Again, I'm not a financial advisor. I'm definitely not your financial advisor, but you know, from like when I talk to friends or colleagues or family, right? And so you know, in this concept, like indexing is great, but you never ever want to just set it and forget it, sort of thing, because you know, you want to take those basic principles and learn them, like dollar cost averaging, um, and buying low, sell high sort of ideal, which I don't recommend. I always recommend to hold for the long term, whether it's a bull market or a bear market. Please understand you should consistently invest in your investments. And the reason I say that is because, believe it or not, you can do the math on this, whatever time period you're looking in. Most times in the bear market, there are huge gains when that specific stock recovers, or if it recovers. You are typically grabbing onto those gains that happen when it recovers. And you can see a lot of that here. I'll show you on here. A lot of these stocks here. I think a good one would be Bank of Nova Scotia, actually. I'll show you this one. So you can see here, the average price I bought this one at was $54.58, to give you an example. And now today, the price is $78.27. And so, you know, I bought it at a time where it was last year during around March, around the fall, September. You can see right here. And I captured the gains all the way up to this price point. There's another one here. A lot of these are in that same position. I think this one here as well, which is Manulife Financial Corporation. The average price, $19.26, went up to $26.83. You could say that we were in a bear market, but we weren't really. It was just kind of a blip in the marketplace last year, March. Not BCE. I think Royal Bank was a good one. Here it is. So Royal Bank really, nope, that's not the one. What was it? BMO, maybe? I don't even know my positions, but just to show you an example. So here's a good one. $86.88 went up to $116.80. And that was buying during a time it was low. So staying invested for the long term, buying and holding, not buying, but investing, whether it's the bear market or the bull market, you know, staying invested for a long period of time. I'm talking 5, 10, 20 years, maybe forever, the companies that will be around. And so bear market, always invest. Don't always just invest in the bull market, because the majority of your gains will come from investing during a bear market. And so just be cognizant of that, because you would be missing out if you just invested in the bear market, and you don't want to miss out on any gains on your portfolio or your investment, right? So, you know, ride out your stocks, whatever investment class it is, ride it out, let it ride out the storm and let it recover on its own. The cool thing is that when you do that, as a new investor or an experienced investor, it reminds you, if you're an experienced investor, it reminds you of your resolve to maintain, that position and believing in the company. It brings you back to the fundamentals, the basics. And same thing with new investors. I know this year, a lot of new investors have been caught off guard with the way the market's going and a lot of these hype stocks. And that's totally fine, but just remember that you have to ride it out if you truly believe in the company. Okay, if you do your company research and stuff like that. So ride it out, let it do its thing. I don't have time for all of it, so next one is limiting. It's not bad advice. It's actually pretty good advice, but we always want to add context to that. And so limiting your expenses, you know, doing a budget with your finances, and gives you the ability to, find where you can take some money and invest or save in your portfolio or in your accounts. The downside to this is Well, the downside with budgeting is that you can get yourself and go into budget hell, which, in my opinion, what I mean by budget hell is you suck all the enjoyment out of your life because you are budgeting to every single thing, and you have nothing for set aside for enjoyment in your life. The thing is with investing, it's not a get rich quick scheme. It's definitely not. And if you're one of those, day traders or not day traders, but there's people in general that think you're gonna get rich real quick off the stock market, which you probably can. The idea of investing is for the long term. And so just, I know it's gonna take some time. That's just the way it is. Just chill out, relax. It's going to happen eventually. Your wealth is going to build. And it just builds, you do it for the long term, and it builds sustainable habits. Okay. And it helps you enjoy the journey along the way. Like, that's all you need to do. I think, like, going back to the last point where I'm talking about investing in the bull market, a lot of people, I know some people that track their net worth around everything, around their investments, around everything. Imagine a bull market if it's down 30%, like your net worth just drops down, and a lot of people revolve their life around this net worth. And sometimes that can be a bad thing because they just feel like they're going backwards. But the core of it is that, you're buying these assets, stocks or whatever it is, shares in a company. In a bear market, you're increasing your assets, like your assets. So the amount of shares, the amount of percentage you own of the company, so on and so forth. It gives you that feeling of ownership, but it's invisible. Your returns are invisible because it looks like it's not doing anything, but you're building up more of your assets, if that makes sense. So you're building that up, and on paper it may seem like you're losing, but you're accumulating more and more assets at a lower price, and eventually those gains will come back. And it could be a year, it could be a few years, right? But you're accumulating as many assets as you can, even though you feel like maybe you're not, your net worth is not moving forward. So just a side note on that. But budget, limit your expenses, but of course, don't suck the enjoyment out of your life. It's supposed to be a journey. Enjoy the journey, chill out, relax, let it do its thing. Just have systems in place and be consistent. So last one but not least, not analysts, but your typical Wall Street guy, the guy who is rah, always like, oh, the market is going up high, you should buy this company, we have price targets of this much, and we're going to short it this much, and we it's going to go this much. Don't take them too seriously. It's funny because there's much more to the stock market than what it presents on the surface. We have to understand that when investing, you are an owner of that company when you own a share in that company, and you should feel some sort of pride for owning a piece of that company, even if it's like 0.00001% of the company or even less than that. Have ownership of it, and don't be the person that is always trying to be, the Wall Street guy who makes, or a YouTuber or somebody on here who makes one correct price prediction, or nails it on the head on, this stock is going to explode 10x. Like, props to them, 100%. But that's like being a psychic. You get one guess and then everyone praises you for it, and then that person feels like they can guess every other stock, every other company's predictions and things like that. And then people flock to that. People get attracted to that for some reason. But don't forget, he probably made 20 guesses that were completely off, or 20 calculated guesses on a stock price and was completely off. And he got one right, and then he got a viral video or whatever it is, right? That's not how you make money, right? I know we're all trying to make money in the stock market, but understand that the stock market is an actual marketplace that comprises of businesses that actually make money in the real world. Okay. And that's aside from what the Wall Street guys do. They make money off commissions or brokers, like, trading platforms like Wealthsimple Trade or whatever it is. they're making money off of commissions, you know, so placing a trade, they make money off of that. They make money moving money, which is weird. But understand that there are businesses that are doing well from a business perspective, not from a share price perspective, right? And so that's where intrinsic value comes in. That's why we study certain companies, we research them, and so on and so forth. So please understand that the stock market is an actual marketplace that comprises of businesses that actually make money in the real world versus the value on a share price. Because if a company is making money and profits, that means it's a good company, in my opinion. And the share price might not reflect that. And that is where, you know, there are inefficiencies in the marketplace. If this company is doing well and the stock price is down just because it's not a popular stock, I'm gonna buy into it and I'm gonna capitalize on, you know, when it starts getting out public or becomes the next flavor of the month, you know. But always looking at intrinsic value of the company. These are companies that are actually doing something in the world that actually matter. And sometimes I know a lot of the times, most of the stuff, investing can be speculative when you're going on the internet and trying to find information about learning about the stock market. Some of these companies don't even make $1 yet. And they're still trying to find funding and trying to put a product out in the marketplace. Please be aware of that. Like, some companies aren't even making money in their public, right? And so always look for companies that are doing well on their books, their financials and things like that. And don't just look at the share price, because it's not healthy. You know, it really misconstrues, you know, the way you think about the marketplace and so on and so forth. So other than that, guys, I know it's a longer video, but it was a video I needed to make. And let me know if you guys did enjoy the video, if you didn't enjoy the video, really, because this is a totally different kind of video. And again, I'm not a financial advisor. I'm definitely not your financial advisor. So this is just a guy on YouTube making a video on his opinion on the worst advice that he hears and sees on the internet. And so if you are a new investor, just keep learning. Don't try to jump the gun. Take your time, build your foundation, and build systems in your life, and just really understand basic principles and concepts when it comes to the market. And so hopefully you guys did enjoy the video, and we'll see you in the next one. Bye.